So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again, and welcome back to the Daily Call. On today's Daily Call, we're going to be talking about option writing strategies and exiting these positions before expiration. So today's call basically came out of a question that somebody emailed me. And again, if you have a bunch of questions about options trading or strategies, and you want to email them or tweet them in or leave us a private voicemail at optionalpha.com/ask, we will definitely get them added to the list for these daily calls because we're doing them, as you know, every single day. And so this helps me just figure out what you guys want to hear and what you guys want to learn. So in this case, somebody emailed in, they said, hey, can you close out a trade before expiration when writing options? Do you still get the premium? How does this whole process work out? I don't really understand it and it doesn't make sense. So here's the deal, and we'll just take this step by step. When you are doing an options writing strategy where you are effectively selling options to open, so you sell a spread or sell a single call option or a single put option, you then have the requirement as an option seller to close that position before expiration or let the position expire. Now, I always say, and the easiest way to think about this is that if the position is in the money, meaning if your strike is in the money at expiration, you need to be active in closing the position. So you need to take an active role in actually reversing the trade and closing out of that position. If your strike price is out of the money, which is ultimately what you want your strike price to be out of the money, then you can let that option contract go through the expiration process because it will expire worthless and it won't do anything to your account. Now, that doesn't mean that you can't close out that contract earlier or in advance of expiration. You don't have to let the option contract go through the expiration process and expire worthless. You can actually go in at any point as an option seller and physically close back out of that contract. So remember, as option seller, you have the requirement to fulfill the trade and complete the cycle to close out of that contract or let it expire worthless, right? Now, if an option contract is in the money or even out of the money and you want to go back in and close it, all you simply have to do is buy back the contracts that you sold. So if I sold a put option at a 50 strike price, at some point in the future, I'd want to go back in and buy back that put option to reverse the trade and close the loop, close the trade cycle, and take whatever premium is left. So to kind of work through a simple example here so that helps out, if I sold a 50 strike put option on a stock that was trading at $60, then I would make money as long as that stock traded basically above $50. Let's say I took in a $200 premium for selling that 50 strike put option. Now, if at expiration the stock is trading at $60, I can basically let that put option expire and I keep that $200 premium. I sold that option contract is out of the money at expiration. I don't have to do anything unless I want to. And if it expires worthless and out of the money, I keep the entire $200 premium. But now let's say that it's expiration and the stock is trading at, say, $51. So it's close to expiration. The stock's trading at $51. I traded the 50 strike put. I'm nervous that the stock might go in the money. The stock might go down by a couple dollars. So I might go back into the open market and buy back my put option that I sold, which might have a little value left in it. Maybe it has $10 of value. So I'll pay $10 to close that contract. Now remember, I collected $200 of premium initially for selling that contract. If I buy that contract back for $10 from somebody else, I still pocket $190 of profit. And now my risk is totally gone and I've closed out the contract, I've reversed the loop, and now I'm totally done, right? So again, the premium that you collect, you basically hold on your balance sheet or on your ledger, but you have to basically maintain that premium or keep it as much as possible. And you can use part of that premium to go out and buy back those contracts, hopefully for a lower price. And the third scenario, of course, is that the stock is trading down below your strike price of $50. So the stock is trading, let's say, at $45. We collected a $2 premium, but now let's say that the stock ends at $45. We would have to go out and either buy that contract back for $5, which means that we have a $300 or $500. So it means we have a $300 net loss on that contract, or we'd have to go through the exercise and assignment process, which we usually don't want to go through. So we would try to actively close out that contract before expiration. Again, if the stock landed at $45 and we have to buy that contract back for $5 of value, that means that we take that $5 in option contract values like $500 in notional value. So if we have to buy that back for $500, less the premium that we collected initially of $200, again, that leaves us with a $300 loss on the position. Again, that's assuming that we don't go through the exercise process. We try to actively close out those positions before expiration. So hopefully it helps out. Hopefully it does answer the question. I know sometimes it can get a little confusing, so try to write it out, try to draw it out the first couple times you do it. But yes, you can go through and close out those loops. And that's the way I always think about it, is that if I have contracts that are out there, to really keep the money and make sure that everything's done and kosher and the account's closed or those trades are closed, I have to close the loop. So if I sell something to open, I have to buy it back to close. If I buy something to open, I have to sell it back to close to make sure I complete the full trading circle. As always, hopefully this helps out. If you guys have any other questions, let us know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.